silver is likely to come because the US will presumably, and we don't know this, but as a strategic metal, they're presumably going to now start stockpiling silver. That will create a demand, and that would mean potentially a higher price.
I wouldn't say it's breaking down, but more than the usual amount is coming off the COMEX, which implies, again, I can't put it into a proof formula that we're looking at more silver taken off, because it really is a place to go to get it, especially in a timely manner. Maybe you called up the refiner and said, hey, we're at this level, and it's going to take, 4 weeks. Really? Okay. Well, I could get delivery next week if I just stand for delivery or whatever. So again, I'll make it an implication. I'm wearing a hat. You can take it for what you want, but that's what it shows me.
David Morgan believes the silver market is sending signals that can't be ignored, with physical investment now playing a decisive role in shaping global demand. Over the past 15 years, silver purchases have swung wildly, from a low of 157 million ounces in 2017 to an all-time high of 337 million ounces in 2022. In 2024, silver has already surged 34%, outperforming gold and even Bitcoin, as investors turn to it amid mounting debt, geopolitical turbulence, and the view that silver remains undervalued. Unlike gold, silver's unique role as both a monetary and industrial metal makes its demand more unpredictable, and the ongoing drain from COMEX warehouses is a powerful indicator that the physical market is tightening fast. The activity at COMEX highlights just how quickly conditions are shifting. Traditionally, it has been a paper market where less than 1% of contracts ever resulted in delivery. However, that norm is breaking down. In the first days of the August contract, 1.7 million ounces were delivered, while nearly 1.9 million were withdrawn, indicating that more silver left the system than entered. For Morgan, this echoes historic commodity squeezes, such as those seen in palladium, where physical shortages led to explosive price spikes. The change signals that investors are no longer satisfied with paper bets. Many now want the real metal in hand, suggesting a growing distrust in paper promises and a heightened urgency to secure tangible assets. Such behavior suggests deeper structural flaws in the financial system. COMEX famously placed limits after Warren Buffett acquired 130 million ounces years ago to prevent a single player from draining its stockpiles. Yet today, delivery rates have surged to 100% in certain contract periods, breaking with decades of precedent. While Morgan doesn't predict a sudden collapse of the US dollar, he warns of an inevitable transition, one already underway, as smart money shifts into gold and silver in what he describes as a crack-up boom. If this trend accelerates, silver could find itself at the center of a historic revaluation, with its scarcity and dual purpose making it both a safe haven and a critical industrial asset. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Last week, I talked about the ebbs and flows in the silver market. So going back to the big picture. In the futures markets, if you look at the softs like cocoa and cotton, or you look at the ags like wheat and soybean oil, or you look at the metals, any of those sectors, usually you only get about 1% of the total that actually gets a delivery against the contract. So 99% of the time, you're just pushing paper back and forth. And that's what the futures market is. It's a derivatives market where settlement is almost always in cash. There are exceptions. There are deliveries of cotton and cocoa and silver. So on silver specifically, we have seen a big change over the last year or so. And this was primarily, and there's arguments about why the silver moved from London into the COMEX, but it's primarily an arbitrage opportunity. And the big players that own the silver physically are able to take these boatloads of silver and move it from a location to another location and still make a spread on it. The inflows and outflows have just been above normal. I mean, anyone that's objective and could count knows that that's a fact. In fact, in the weekly perspective, I believe last week, I went through the numbers. I don't have them memorized, but we've had a significant more activity in and out of the COMEX over the last, like I said, year or so. And I did note that, I watched the flows rather carefully, not as avidly as I used to, but I still pay attention to it. And whenever we got to the registered category, which is the amount of chips that the registered category, being the dealers, have available, when that gets thin, it's like playing poker and you have a big stack of poker and you're losing the game, and all of a sudden your stack goes way down. And that indicates that they don't have much physical silver to deliver into someone standing for delivery. And it got down to like the lowest level I'd seen in a very long time, and it stayed there longer than I'd ever seen before. And I made note of that to my subscribers, and probably publicly, I don't remember. And pretty much after the words were out of my mouth, we start to get this huge build in the overall categories, primarily in the registered category, and primarily from the LBMA. So those are facts. But the one I want to stress is after Warren Buffett bought 129.7, rounded up to 130 million ounces off the COMEX, he actually only delivered 90 million instantly. And he took, the offer, I guess, to get the rest, the other 40 million over time. And if I remember correctly, someone can check me, but I think it was after that. I'm pretty certain it was after that. There was a limit on 7,500 contracts that you could take off the exchange. Now, I think that's gone away because we haven't seen that in quite some time. But the exchange is kind of protecting themselves because they wanted to prevent someone coming in and buying up the whole silver supply and saying, all right, we're standing for delivery. So whether that holds now or not, I just want to bring that to everybody's attention. So the bottom line is this. It is a fact that the ebbs and flows in silver, gold as well, through the COMEX has been greater these last years or two than it has been previously. That's just a fact. Whether someone says it's normal, I'd say it's quote unquote normal in air quotes, as long as everybody that stands for delivery gets their silver or gold in a timely manner, then yeah, of course it's normal, because it's supposed to be, as stated, available to anyone who stands for delivery to get the product, whether it's cocoa or cotton, soybean oil or silver. Yeah, I'm glad you brought that up, because in most cases, you've got these, we'll call them large pallets of silver, 1,000-ounce bars. And on that whole pallet of however many bars there are, I never counted them, there's a tag that says HSBC. And then someone stands for delivery and they take off the HSBC and they put on JP Morgan on it, and the silver never moved. But ownership did, but it never left the warehouse. The only way to track that is to see how many semi-truck trailers come in there and actually take it outside of a COMEX warehouse. And that part of the activity has changed as well, more than before. I mean, just on the input, when you're sitting there and all these, semis pull up to COMEX warehouses and there's more than one of them and delivers 1,000-ounce bars, and someone's got to, take a forklift and move them in and put them in a pallet or on a shelf. That is a physical movement that increases the silver supply. And that's what took place. So someone say that it's all a paper change is incorrect in this instance. What it indicates to me is that I looked at the COMEX once I understood how it really worked, with 99% just being a paper push, that anything that came off had some substance to it, because I look at it as, and you don't have to agree, it's kind of the place of last resort, the last place you're going to take the silver, and not necessarily, but it's certainly not the first place. I mean, anyone that's in the industry, be it a fabricator for silver shot or screen or wire or all the different fabricated things that silver goes into, which is vast, they get it usually direct from a refiner or smelter, and they do what they do. They don't ever take it off the COMEX. And so who takes it off the COMEX? First of all, very few, but those that do usually are for investment purposes, but not always. But let's say you're in industry and you can't get it anywhere else. Well, there it is. Stand for delivery. So that implies, but doesn't guarantee, that the supply chain, I wouldn't say is breaking down, but more than the usual amount is coming off the COMEX. which implies, again, I can't put it into a proof formula that we're looking at more silver taken off, because it really is a place to go to get it, especially in a timely manner. Maybe you called up a refiner and said, hey, we're at this level and it's going to take, 4 weeks. Really? Okay. Well, I could get delivery next week if I just stand for delivery or whatever. So again, I'll make it an implication. I'm wearing a hat. You can take it for what you want, but that's what it shows me. And this has happened in others. I mean, there's others. It's called rapeseed oil. It's really canola oil. And there was a shortage a long time ago, and that market went just absolutely ballistic, like palladium did at one time. But it was what I call popcorn rally. It went from here to almost straight up. The deliveries were made, and it came right back down. But it does happen, and it is happening, and I'm just...
Another renowned analyst, Clive Thompson, points out that silver's addition to the U.S. critical minerals list marks a significant shift in how the metal is viewed, not just as a financial asset, but as a cornerstone of modern industry and national security. Long valued for its use in jewelry and as a store of wealth, silver has now become essential to advanced technologies, renewable energy, medical applications, and defense systems. By formally designating it as critical, the U.S. is signaling the need to secure steady access to silver through measures such as domestic exploration, strategic stockpiling, and support for mining initiatives. However, with the U.S. relying heavily on imports, particularly from Mexico, any disruption in trade or geopolitical tensions could quickly expose vulnerabilities in the supply chain, setting the stage for tighter markets and stronger price movements. Thompson also highlights the investment implications of this development, particularly for silver mining companies. These producers are highly sensitive to price shifts, meaning even modest increases in silver can translate into substantial gains in profitability and market value. As industrial demand grows alongside silver's elevated strategic status, the potential exists for a broad revaluation of the metal, where it is no longer seen as a secondary player, but as a resource central to both economic progress and wealth preservation. For investors, silver's unique position as both a key industrial metal and a safe haven asset makes it one of the most overlooked yet pivotal opportunities in today's shifting economy.
One big source of silver in the United States is Mexico, and that's defined in the report as one of the risks. It's defined as a small risk, i.e. only 4%. But you can imagine a scenario where perhaps Mexico says, right, you've slapped tariffs on us, we're not going to export our silver to America, or maybe they put tariffs on the silver going to America, who knows what. But America is relying on Mexico to get its silver. And in the event that they couldn't get silver out of Mexico, the US economy would lose billions of dollars because it would have to buy the silver from more difficult to obtain places at higher prices. Low probability, but high impact. So silver is moving up in importance in the strategic minerals stockpile of the United States. It's no longer just a metal for coins or jewelry. It's also a strategic metal which is used for weapons and electronics. So who's going to benefit from this? Well, obviously a higher demand from silver is likely to come because the US will presumably, and we don't know this, but as a strategic metal, they're presumably going to now start stockpiling silver. That will create a demand, and that would mean potentially a higher price. The real beneficiary of this will be the silver mines, because as the silver is stockpiled, the silver mining companies should see higher prices and significantly higher prices because of the higher silver price. So as the silver price rises, the profit of the company can rise much faster. To give you an example, let's say you've got a silver mining company mining silver at, let's say, $30 an ounce. That's the cost of mining, or what they call the AISC, or the all-in, what's AIS stand for? The all-in sustaining cost, AISC, all-in sustaining cost. So let's say they've got an all-in sustaining cost of $30 an ounce, and they're selling their silver at $35. Their profit would be $5 an ounce. But let's say the silver price rises by 10% to $38, which has just happened, as we know, then they are still mining the silver at $30, but they're selling it for 38. So their profit has gone from the $5 an ounce that they were making at $35 to $8 an ounce they're making now when the silver price is 38. So their profit has gone from $5 an ounce to $8 an ounce. That's a 60% increase in the profit of the silver mining company. Whilst at the same time, the price of silver has only gone from 30 to 35, which is about 12.5% increase. So a 12.5% increase in silver can create a 60% rise in the value of the silver mining company shares. It does depend on the silver mining company and what price they're mining the silver at. If they're mining it at a very low price, it'll have a small impact. If the cost of mining is very high, it'll have a high impact on the share price. So that's the breaking news regarding silver. How can you benefit from it? Well, first of all, you can buy silver in lots of different ways. If you want physical coins or bars, most large coin dealers will sell you quantities of silver. Bear in mind that you might have taxes depending on the country you live in when you buy, and there'll be also quite a premium over the silver price because it costs a lot of money to make the coins or the bars and to distribute them through the dealers. And of course, the dealer's got to pay his rent and have his markup to make a profit. So don't expect to be able to buy silver at the silver price if you're buying a physical metal in small quantities. And if you're buying in physical metal, what sort of metal would I suggest you buy? Well, I think there's three types which are interesting, maybe four. The first type is in the country where you live, they probably had silver coins of the realm. So in the UK, I think that's silver coins pre-1947. In Switzerland, it's pre-1967. I don't know what year it was in America. I haven't got that in my head, but it's probably pre-19... No, it was 64, I'm guessing. But doesn't really matter. But you can look it up easily and find out what coins existed in silver in your country. And almost certainly in many places you'll be able to buy bags of these coins, which will be recognized by citizens of the country. That's a good way to buy junk silver coin, or it's called junk silver coins. The second way is to buy what's known as bullion coins. These are well-known coins like Krugerrands, maple leaves, harmonicas, Britannias, American Eagles, and so forth. You buy these coins and you can buy them in boxes of, you can buy them in any size really, but let's say you wanted what's called a monster box. That's 500 coins, that's 500 ounces. It's quite a lot of silver, pretty heavy, but you're getting something which is starting to look really great if you've got a monster box full of silver coins. And because they're bullion coins, they trade at the lowest premium over the silver price. Then you can buy another type of coin, which I kind of call collector coins. They're not particularly rare, but they're fun to get. So, for example, in various countries, they have different types of collections. For example, in Canada, they have the Arctic Animals collection. In the UK, they have the Queen's Beast collection. In Australia, they have the lunar animals, the lunar coins they're called, with all the different animals of the zodiac. And each year they'll bring out a new animal and you can buy the coins. But of course, you'll find it very hard to get anything other than the current year. But it's great fun to collect the current year and then see if you can find the coins from the previous years. And over time, if you're lucky, you might get the full collection by looking around a bit here and there on eBay and auction sites and
from calendar.
Local places where you could be looking. So that's getting the coins. Then you can buy bars, physical bars, and the physical bars come in sizes or 1 ounce, 10 grams, 50 grams, 100 grams, 1 kilogram, 400 ounces, that's a very large bar, and so forth. So you can buy physical like that too. What if you want to not have the physical? Well, the advantage of not having the physical and having it in custody is the spread, the bid-ask spread is usually a lot less. So if you buy through a big bank who sells silver or through a broker or a dealer, you can probably buy quite large quantities of silver and have them stored by the institution concerned. That's not a bad idea, and often it's a way of not paying the local tax, the VAT or sales tax that you might have in your country. Another way of buying silver is through the exchange traded funds. I would recommend that you go for an exchange traded fund which trades on the stock exchange of your country, and also one which is described as physical silver. So it says they hold the physical silver, and most of them do, but just double check the fact sheet. So you look up, if you want to choose one, you look up exchange traded funds silver, and you'll find one probably in your country, and then you can buy, make sure it says physical silver. If you're not sure, download the fact sheet from the website and just check it says physical silver held, and then you could buy that. And the last way you can buy into or get exposure to the silver price is through the silver mining companies.
Silver has been gaining quiet but steady strength, and for anyone watching closely, it feels like the market is on the verge of something dramatic. With prices recently approaching the $39 mark, all eyes are on the key $40 level, a number that carries both psychological and technical significance. Crossing it wouldn't just be another price move, it could act like a spark in a dry field, igniting momentum and drawing in a flood of new buyers who have been sitting on the sidelines. This type of breakout has the potential to shift silver from a slow climb into an explosive rally, the kind of run that catches everyone's attention and reminds investors why silver has always been considered the people's metal. But the real storm brews beneath the surface. If silver surges past $40, short sellers could face an avalanche of margin calls and forced buy-ins, setting off a chain reaction of panic that drives prices even higher. That's when the difference between paper and physical silver becomes more than just a debate. It becomes survival. Paper holders may find themselves trapped in contracts that crumble under pressure, while those holding real, tangible silver could see their patience rewarded in a way that feels almost historic. The bigger question is whether people will recognize these warning signs now, before the move truly takes off, or if they'll only wake up to silver's power once the window of opportunity has already closed. Share your thoughts on the expert's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.